Scenario 1. So scenario 1 is where we have our loan and we have our salvage value, which is our market book value, and we have our loan and interest. So what we did is we took our years and calculated our operating incomes, including all the expenses that are there and the forecasted uh, taxes, levies, and including our rent income as our only income. Loan repayment, we used annuity, as we already discussed that we between the two method of paying a loan, we choose annuity as our final option. Then we calculated before tax our cash flow with depreciation of this much, as we already seen, and the depreciation aspect that in 2014 the property was this much, in 2018 the property is this much, therefore there was an increase of this much, and if you divide this by 5, therefore it makes sense to say that this is our depreciation. So we use for scenario 1 the same narrative, and we calculated our depreciation, and then we calculate our B value, interest of the loan, taxable income, and our tax, therefore after tax was calculated. For this reason, we calculated our tax rate, as you can see from the tax table, therefore so that we can be able to calculate MAR after tax, and this was used to calculate our NPV. Scenario 2 followed the same process, whereby we have this, but now we have additional cost of 3.5 of fixing. So if we incur that, therefore this is still our loan, now still our depreciation, still our book value, interest on how much is still the same. Now this is still our taxable income, this is our tax, this is our after tax. So we follow the same method to calculate for scenario 2, and what we did is we compared the two options. So after comparing the two options, we realized that now scenario 1 is more preferable, not because of the NPV value, because you can see from case 1 and case 2 that case 2 has a bigger NPV value, but because of the cost, it costs us more to actually get to this NP value, and the difference between these two are very small, so therefore we chose case 1. Now to further continue, we included case 3 scenario, whereby we are selling the property. When we are selling the property, we realized that actually this process we're gonna sell the property for this much, while it costed us this much, having a profit of this much. Therefore, we have expenses that we have to take care of, and then a net profit of this. Because of this is a capital gain, we're going to use the SARS capital gain process, of which the percentage are given as follows. And then from there, then we're going to choose an investment option to invest this money. In this case, we chose CV Capital. CV Capital is a company that is a low risk and less return compared to most of portfolios. This is what they charge you to actually send the money into their portfolio, and that's how much interest they will earn and commission that will charge you. Then we can calculate how much tax will be accounted for, and at the end we'll find that we have a rate of return of 170 in 5 years, therefore leaving an amount of this much after 5 years. And if we calculate our loan that we still owe, future value we get is this much, and there's a difference of this much. So clearly we can see that this option of investing is way better than other traditional method. because at the end our client will have so much money left for her to use. Now, for clarity, we use forecasting to forecast for uh, our salary increase, our uh, our reliability on the BNB option of renting out. We also did focus on uh, tax. We also did focus on levies. Yeah, thank you.